Hi everyone, Vineet here, certified financial planner and founder of Estonia Proud Wealth. When you think about retirement, one of the big questions is, where should I actually keep my money so it lasts as long as I do? It's not just about chasing the highest return, and it's not just about playing it safe either. The real challenge is inflation, the silent force that quietly eats into your purchasing power. Over the last 30 years in Australia, prices have risen by around 2.6% a year. That means every dollar you hold has to work just to stand still. So today, let's explore 7 common retirement investment options Australians turn to: cash, term deposits, property, annuities, shares, and managed funds, and see how they have performed over time. We will talk about the benefits, the risks, and how each could impact the longevity of your retirement savings. This isn't about telling you what you should do. It's about exploring together, asking the right questions, and looking at what history can teach us. Let's start with the simplest one: cash in the bank. Over the last 30 years, cash has returned about 4.1% per year, just a little above inflation at 2.6%. But that's before tax. For many retirees, the after-tax return meant they were really only trading water. Cash does play an important role. It gives you liquidity and peace of mind. Many retirees like to keep 1 or 2 years of living expenses in cash so they don't have to sell investments at bad time. But here is a question for you. Would you feel comfortable if most of your retirement savings was sitting in cash, knowing it barely grows over the long run? Next in the line are term deposits. They're very popular among retirees because they feel safe. You lock in your money at a fixed interest rate, today usually around 4% depending on the term. You know exactly what you will earn, and that certainty is valuable. Term deposits can work well for short to medium term needs, but over 20 or 30 years, they face the same problem as cash. Inflation slowly erodes their buying power. What do you think? Would you choose certainty even if it meant potentially falling behind inflation? Now, let's talk about investment properties. Property has been a huge wealth builder in Australia, and for many people, it feels more tangible than shares. You can see it, touch it, and even live in it if you need it. It can provide steady rental income stream and potential for long-term capital growth. But in retirement, property brings unique challenges. It is illiquid. You can't just sell off a small piece if you need cash. There are ongoing costs like maintenance, rates, insurance, and sometimes land tax. And if you're managing tenants, it can be stressful when you would rather have less responsibilities. Plus, with today's high interest rates, holding investment property isn't as cash flow friendly as it once was. So here is a trade-off. Property can be a solid part of wealth, but it's not always the most flexible option when you are trying to fund a smooth and reliable income in retirement. A very different option is lifetime annuities. Think of them as a contract with an insurance company. You hand over a lump sum and they guarantee you income for life. No matter how long you live, the payments keep coming. That certainty can be comforting. Some annuities also get favorable Centrelink treatment, which may help with age pension eligibility. But once you commit, your money is locked away. You give up flexibility and returns are usually lower than the growth investments. You are essentially trading upside for peace of mind. So let me ask, would you prefer the comfort of a guaranteed income or the flexibility of managing your own investments, even if that means more ups and downs? Now, let's look at Australian shares. Over the last 30 years, Australian shares have delivered about 9.3% per year, more than triple the rate of inflation. That's a powerful wealth builder. On top of that, dividends in Australia come with franking credits, which can boost your after-tax income. In retirement phase, inside super, Those credits can even be refunded, making Aussie shares particularly tax effective. But they are not without risks. Shares are volatile. The ASX fell over 40% during GFC. If you retire and need to sell shares at the wrong time, that volatility can hurt. So the key question is, how much of your investment savings would you feel comfortable keeping in shares, knowing they can deliver strong long-term growth but also sharp short-term falls? Now let's add international shares to the mix. Over 30 years, they returned about 8.3% per year. Again, well above inflation. The advantage is diversification. You are not just tied to the Australian economy, you get exposure to the tech giants, healthcare innovators, and global brands. The risks: currency swings. If the Aussie dollar goes up, your overseas investments can fall in local value, and foreign tax rule can shave a bit off your returns. But historically, international shares have been an excellent complement to Australian shares, giving retirees more balance and reducing reliance on one market. Would you feel more secure knowing your money was spread across the world, or do you prefer the familiarity of local companies? And finally, managed funds and ETFs. They pool your money with other investors and spread it across hundreds or even thousands of assets such as shares, bonds, property, etc. ETFs in particular are low cost, simple, and widely used. The benefit is instant diversification. You don't have to pick the winners. The risk is you still ride the ups and downs of the markets. But history shows that staying the course with a diversified portfolio has rewarded patient investors. So the question is, would you rather spend time managing individual assets, or would you prefer the simplicity of letting a diversified funds do the heavy lifting? So when we look at the history, story is clear. Inflation averaged 2.6% a year. Cash barely kept up. Term deposits offered certainty but little growth. Property and annuities provided stability with trade-offs. And shares, both Australian and international, plus diversified funds, pulled well ahead of inflation, but with more bumps along the way. Each option has its strengths, each has weaknesses. The real question isn't which is best, but how you combine them in a way that works for you. Some people want steady income, others want growth, and many want to balance both while leaving something behind for family. That's where we come in. If you would like to explore how to build a portfolio that balances income, security, and growth, and one that delivers not just on your retirement lifestyle, but also on your legacy, talk to us. We would love to have that conversation with you. Thanks for joining me, and I'll see you in the next video.